All right, welcome to another episode of The Property Prescription. We've got Saskia here again.
Yep.
Today we're going to talk about capital gains tax.
Yes, we are.
Again, working late, budget night, 3 a.m. You're at all hours, so fantastic work on the white paper.
Thank you.
Well done.
Well, I do love it actually.
You do?
Well,
yeah.
Not so much. I don't really love the reform itself, but I do love the work.
Well, the Wednesday morning was quite stressful for everyone here.
Yeah.
But we got through it.
Yeah.
We've been able to calm our clients down and talk them through it. So today let's talk about the changes to capital gains tax, 50%. Over to you.
Yeah, well, I think that the first thing to cover off on is that unlike negative gearing, the capital gains tax changes affect all asset types, all
including
investment
shares,
types, including
equities.
shares, including shares. So that's a really important difference and, something to definitely keep in mind. In terms of what's actually happened, we've gone from having a 50% discount on your capital gains tax to essentially a model that takes into consideration what inflation has done over the lifetime of holding that property. So for most properties, it will result in a higher capital gains tax bill.
Correct. But we actually modeled when we wrote out the white paper.
Yes.
We went through two examples.
Yes.
One in Brisbane and one in Adelaide.
Yep, I've got them right here.
So let's go through the white paper and let's just dissect that, because I thought they were fantastic examples and it also resonated in terms of some of the discussions we'll talk about right now.
Yep. So these are real examples from properties that we actually purchased for clients, and we went back and pretended like these new laws were in place to see what the difference would be. So we have a property in Brisbane that was bought in 2016 for $877,000, sold in April of 2026 for $1.75 million.
Great result.
Awesome result. And when you take into account the associated costs with that, there is a capital gain of $770,000. So really, really excellent result. Great position to be in. And we also did another property in Adelaide, which was bought in 2018 for $782,000 and sold in 2026 for $1.52 million. And after costs, that was a $635,000 capital gain. And we've got the full breakdown of this in the white paper, which any of our clients...
Jump on propertyfordoctors.com.au and we'll send it through to you on both the negative gearing and the CGT white paper. It's fantastic. If you want to read through it, it's quite lengthy.
Yes.
But it actually breaks down everything properly. So I think you've done a great job there. So
Thank
is the end result with the CGT changes?
The difference between the two, in the Brisbane property, with the 50% discount, you're paying $183,000. This is assuming the highest tax bracket. And with the new CPI adjusted rules, you'd be paying $217,000, so a difference of $34,000. And for the Adelaide property, with the 50% discount, we've got $150,000 of CGT, and with the new reform, $183,000. So we're looking at an extra $32,000.
So I think the really important takeaways from this, if we're talking to our doctors, in terms of buying an established property, a good quality established property, we're going to get good rental growth and good capital growth. What's the end outcome?
Well, I can't imagine a doctor looking at a gain of, hundreds of thousands of dollars and being deterred by paying an extra $30,000 of capital gains. It just doesn't make sense for that to impact your investment strategy, to be honest.
Absolutely. And even buying sort of a new versus, we'll talk about that in the next episode, but new versus established. I would much rather advise a doctor, quality client, to actually go and buy something of quality. We're going to get very strong rental growth, very strong capital growth. Yes, you're going to have to pay a little bit more tax. So we talked about this previously. But at the end of the day, I'd much rather have one of those assets sitting in a client's portfolio.
Absolutely.
Rather than say some of the new stuff that you're looking at the moment. Do you want to take us through that in terms of rental growth and capital growth?
I think in the discussion about new versus established property, it's really important not to let a slightly higher CGT bill scare you into purchasing something that is not going to give you good results.
Spot on. Absolutely spot on.
It's just, you really have to look at the quality of the asset, the supply and demand story in the area that you're purchasing in, get proper advice, and do not panic and purchase something that is not going to give you good results because you think that these small benefits are going to add up to outweigh the returns that you get on a high quality established product.
Correct. So I think they both play a part in the overall portfolio of a client's portfolio.
Yep.
Just that we still have to be data driven. We
Yes.
still need to be selective in terms of what we're buying, and it still needs to fit into that doctor's portfolio.
Yep, absolutely.
So picking off the back of that comment and that statement, CGT modelling, we've actually put this in the white paper as well.
Absolutely. We've put everything in the white paper, don't worry.
This is really, really interesting. So basically, let's talk about the modelling and how we modelled it. Obviously, there are some assumptions in there that we put in there.
Mm-hmm.
But let's go through it. Okay.
Let's do it.
So it was assuming a 7% compounding growth rate.
Yep. So if we're assuming a 7% compound annual growth rate over an asset held for 10 years, and we're obviously assuming the top tax bracket, if CPI is at 4.5%, which we're not far off at the moment, you end up paying less tax under the new regime. Your effective tax rate would be about 20.3%.
Yeah, and the government have got a target to get us in an inflation rate of 2 to 3%.
Yeah.
Do we think that's going to happen over the next 12 to 24 months?
Look, the way that the geopolitical environment is at the moment, I'm finding that hard to believe. Construction costs are very high. The oil crisis, we're not setting ourselves up to be getting under that target. I mean, obviously they're putting the cash rate up to try and mitigate that. But
it's going to be really interesting. Cost of construction and cost of living are two really big factors that we're looking at in terms of the data. So even at 2 to 3% sort of rate, if we assume sort of a CPI assumption of 2.5%, let's look at pre-reform and obviously the indexation model. What's the difference?
So pre-reform about 23.8% effective rate, and then with the indexation model it's 33.7%. So
still not a big difference.
Yeah, when we're talking about, again, a sophisticated investor, this is absolutely not going to scare them off from investing in assets that are going to make them hundreds of thousands of dollars. It's just the reality.
So the two examples there, and even at a CPI assumption of 1.5%, like that is a little bit more of a jump.
Yep,
We're
absolutely.
sitting at what, 23.8 versus the index
39.6%.
Yeah, correct. So really, if we stay around that sort of 2.5% rate, it's 23 versus 33.
Yeah.
If we go to 3.5%, it's 23 versus 27.
Yep.
We're very close.
Yep.
There's almost parity between the two.
Yep.
And if it's 4.5, you're actually going to be in a better position.
Yeah.
So some investors, they might, the ones that have
absolutely
held property, they've got commercial, they've got residential, the doctors that we've invested for, they're the ones that are going to do really, really well as a result.
Yeah.
They're not going to be selling anything because they're still getting the gearing benefit. So it's going to be really, really interesting over the next sort of 12 to 24 months.
Well, I believe that there was a study done by, I believe it was realestate.com, and they found that I think it was 27% of properties that were sold in the last decade would have been better off under the new reform. I'll have to fact check that and pop it up on the screen if it's wrong. But obviously our target is to be exceeding what the national average is in terms of growth for our clients. So we are more likely to get hit by a higher CGT situation. But again, there's no way that you're not chasing the best return you can at all times.
So it's quality, isn't it?
Yes.
It's quality,
always
growth
comes back
focused,
to quality.
Data driven. We get audited as well.
Yes.
What have you performed at since we actually got our new audit performance?
Yeah. It's about 13%.
Since
our
inception.
returns.
So it's pretty strong.
Yep.
So if you get that growth for a doctor and you build it up over a long term and you have a balanced portfolio across new, established and commercial, I think you're going to do really well. So it's not as alarming as what we were expecting.
Absolutely not.
Which is good.
It's definitely not. And again, contact us for the white papers and you'll get the full breakdown. You can read it for yourself and digest it. But yeah, the story is absolutely not.
It's not panic stations.
It's not panic.
Yeah.
Absolutely not.
Fantastic. Thanks, Saskia. Thanks very much.
Thank you.
Cheers.